Hello. Hello.
Hi, Nhyira, good evening.
Yeah, good evening. I hope everybody is doing well today. And welcome to the live stream for our Q&A session. For those of you joining us on YouTube, if there are any questions you have for me on the strategic case study and then principles of taxation also, you put it in the chat for me and I'm going to provide you with some answers as we get excited about our discussion today in that case. Okay. So for those of you on Zoom also, you raise your hand, I bring you up if there are any questions for me. And then you can also put it in the chat for me if you don't want to talk, and let's see what we can do. So as we've been doing since Sunday, the purpose of this discussion is to, or this session is to answer some questions that we are having and quickly do a rapid fire also on the various things that we need to look out for the last time as we go into the exam hall tomorrow relating to principles of, did I say principles? Relating to public sector accounting and finance, and then also strategic case study. So if there are any questions you want me to rapid fire start with, you raise your hand, I bring you up, or better still, you can put it in the chat for me if you don't want to talk. And let it be a direct question, not something you want me to teach a whole topic here. That one is going to be a lot of work. So give me some rapid fire direct questions, and then we're going to be going into the discussion today as we continue. I'm seeing some chats coming in on Zoom. Let's see if I can start picking some questions up. What do we have? Let's see. And therefore I said, good evening. Please, can you touch on service concession, role of the Public Accounts Committee? Yeah, service concession is one of the types of the public-private partnership arrangement. The concept about service concession is that with service concession, what happens is that the private individual, it's going to provide a public good or services that was previously provided by a private sector, a public sector organization. And the difference between the service concession and then maintain and operate, as we illustrated during our final revision session, was that with maintain and operate, what you're doing is that we are just engaging someone as an agent to maintain and operate the government facility on an administrative basis, and we pay the person, and usually that is for 1 to 5 years, and the person maintains those government properties or those government assets for a number of years, and the person is paid a fee for what the person is doing for his or her services for the period under review. However, the service concession is where, yes, we are engaging an individual, a private investor, to come and take over a public asset and maintain that public asset and render that services that a public sector organization was previously rendering. But the issue about service concession is that that individual, as part of the deal, is also required to make some investments, capital investment into the deal, into the asset, and restructure the assets. For that reason, that service concession, the individual or the investor is given a long period of time. It could be between 20, 25 or 30 years, or sometimes more than that, so that that individual can restructure the private sector organization, institution, and also recoup the investment that they put into the asset or the business. An example of this is the Electricity Company of Ghana and the PDS deal in that case. So under the deal, PDS was supposed to inject some cash into the into Electricity Company of Ghana, and for that, I think 20 or 25 years or so, be able to maintain it and then also be able to recoup their initial investment. So about service concession, that is the idea. It is where the government engages a private investor to provide a good or services that was previously provided by a government institution or a government or public sector entity. But in addition to that, the investor is required to inject some capital or put in some funds. And so it's given a long period of time, about 20, 25 years, to be able to recover or recoup the initial investment that was put into it. So if you ask about service concession, that is the idea. But also we shared some thought about service concession and mentioned that when it comes to service concession, we must identify, because in accordance with IPSAS 32, I guess, the grantor, that is the entity who is the public sector entity, may recognize assets under a service concession if the entity is the one controlling the assets, the entity is the one directing, setting the price at which the goods or services is supposed to be provided, or when the entity has some control over the management or the board structure of the organization. Then in such case, the entity who is the grantor, the public sector entity, will then have the ability to recognize assets in respect of the service concession agreement, and definitely recognize liability, which will be the amount of money owed to the private investor who has invested some money into the business. So if you ask about service concession arrangements, that is the principle, or that is the thought about service concession arrangements. Let me know if that makes sense for you. And then your second question was the role of the Public Accounts Committee. Now, the Public Accounts Committee has various roles that they play. Among other things, some of the roles include issues in relation to scrutinizing the Auditor General's reports and the public accounts of various covered entities. Give me a moment. To scrutinize the public accounts and also the Auditor General's report. So that is the first role they play. So after the final accounts are prepared by the Controller Accountant General, first by the various entities, then we put together by the national accounts, Auditor General audits all these accounts, then the reports are sent to Parliament. Parliament hands over that report to the auditor, to the Public Accounts Committee, and the first role is for them to scrutinize the auditor's report and the public accounts. The purpose of that is to identify whether the accounts are kept in line with the various laws, regulations, and whether the value for money principle is achieved. That is the first role they play. The second role they have is to also surcharge or invite before them during a public hearing any public officer that has been found to be involved in any illegal or unlawful transaction. It could be award of contract, it could be the amount of money that the entity spent on an activity, a service, or an undertaking. All of that could be a component about what they do at the public hearing as well. Another thing the Public Accounts Committee does as its role is that at the end of their hearing, they are required to present a report to Parliament on the various findings that came out during their public hearing and the actions that were taken to resolve or deal with those issues. Were the people apprehended? Were they taken to court? Were they jailed? Were they, like, what happened? So the various actions they took and the things that came up during the public hearing will also be included in their report. That is another role they play. And then certainly they will make recommendation to the various organizations whose internal controls were found to be inefficient and ineffective during their public hearing. And that recommendation they make, it is the role of the audit committee and the internal audit unit of these public sector entities to ensure that those recommendations are implemented by these organizations. So if you ask about the role of the Public Accounts Committee also, these are some thoughts that we can share about in that case. So that is the answer to your question on service concession and then the role of the Public Accounts Committee. I see some of you guys joining. You are welcome. For those of you joining us on YouTube, put your questions in the chat. We're looking at public sector accounting and finance, and also strategic case study. So if there are any questions you have, you raise your hand, I bring you up, and then you can also put it in the chat for me, and let me share my thought on them. Jacomani said, Nhyira, before you start, please share your views on what constitutes a capital asset. We've defined capital assets. I came from two schools of thoughts in defining what a capital asset is. That traditionally, a capital asset, like on the average, includes both the non-current assets we have, as well as equity investment, stocks, bond, and all those things. So all those will be included in what? Capital assets. That is one school of thought. Another school of thought is that capital assets should be only assets whose economic benefit goes beyond 1 year, and from which future economic benefit or service potential will flow to the entity. For that reason, that second school of thought, we're going to be dealing with capital assets from the perspective of only the non-current assets. That is infrastructure, property, plant, and equipment, work in progress. Infrastructure, property, plant, and equipment, work in progress. So these are the two schools of thought when it comes to dealing with capital assets. So what I recommended, if you remember, I don't know, maybe you didn't join that session or something like that, or you didn't watch the video as well, was that whatever assumption you want to use in the exam, because we've seen the examiner using the two assumptions in two different questions, where in the calculation of capital assets, infrastructure, property, plant, and equipment was brought, then equity investment was also added in determining the capital assets. Then in another question, we saw the examiner also just bringing in infrastructure, property, plant, and equipment, and then work in progress. Does that make sense? So whatever assumption you use, whether you are going for the equity, infrastructure, property, plant, and equipment, and work in progress, or you are going with just infrastructure, property, plant, and equipment, you just state your assumption down, and then you should be good in that regard. So that is the issue about capital assets. That is the issue about capital assets. Let me check YouTube. Maybe we have some comments coming up. Yeah. Prinsla Asari said, please say, can you elaborate on mechanisms to obtain value for money? Okay, so the mechanism of value for money, that is Priscilla Asari on YouTube, is that there are three basic or four mechanisms. When we are measuring value for money, there are four things that we need to look out for. Economy. If you remember, we mentioned the issue about economy. Economy simply means that the entity obtaining quality resources at the least cost. Obtaining quality resources at the least cost. So we are not sacrificing quality for the price, but we are making sure we get the best price for the best quality of the product. That is economy. That is the first thing on how we obtain or measure value for money. The second thing also is efficiency. Efficiency has to do with whether the comparison between the input and the output. So if we compare the inputs to the output, what is the outcome of that? So efficiency means obtaining the best possible results from the utilization of resources. Obtaining the best possible results from the utilization of resources. That is efficiency. So what is the relationship between our input and then the output? What is the relationship between that? That is efficiency. Then effectiveness has to do with whether the resources or the outcome of the resources, the end product, it's serving the purpose for which it was intended. That is effectiveness. That is effectiveness. The outcome, the end product, is it serving the purpose for which it was intended? That is effectiveness. Then there is also another fourth component, and that is equity. Equity has to do with whether the resources are allocated fairly among various organizations, various entities, or various beneficiaries who are supposed to get the resources that were procured at the end of the day. So that is a concept of value for money. So for instance, if we buy, okay, now we are not wearing nose masks, but then I'm going to use that just as an example for you in that case. So let's say, for instance, the government buys maybe nose masks, or let's say vaccines. Okay, let's say the government buys vaccines because people are still being vaccinated. So is the government buying the vaccine, the best vaccine, at the competitive price, the least cost economy, right? That is the first thing. Then if we look at the vaccines we've bought and then looking at the people that we've been able to vaccinate, is it efficient? Like if you look at the people we vaccinated and then the response from the vaccination, if people are how do we call it? People are vaccinated, but then for some reason, the outcome of that is that people are still getting the virus, then it means that we are not being efficient enough at the end of the day in that regard. Then effectiveness has to do with whether really the end result of the vaccine procurement was achieved at the end of the day, which is to ensure that, we can have herd immunity and also walk freely without wearing nose masks and all of those things at the end of the day. Then equity simply means, is the vaccine being distributed to various communities, various age groups, irrespective of where they are located, or maybe the vaccine is only situated in Accra, in Tema, in Kumasi, in Takrady, or like any other location. That is the idea. So that is the concept of value for money when we are dealing with this. Note that if you remember, I mentioned that the examiner can bring like a standard question for between 5 to 10 marks on the mechanism of value for money, or how we measure value for money, because this is basic and fundamental when it comes to public sector accounting and finance. And also, it's one of the principles, if you remember, when we are dealing with public-private partnership arrangements. So, Praise Lastari, that is the answer to your question. And YouTube, I see some of you guys jumping on. Put in the chat for me any questions you have. I'm going to answer all your questions. For those of you joining me on Zoom, you raise your hand, I bring you up if you have any questions. Or if you don't want to talk also, put it in the chat for me and I'm going to reply you. Anita said, Nhyira, are you in Ghana? Yeah, I'm in Ghana. Why? I'm in Ghana, Anita. Augustine said, cash flow, when you are using direct method when you're using direct, do we still add the version? I don't know what you mean by direct method. Please, if the examiner asks you to prepare the cash flow approach about bringing your inflows and outflow for the operating activity, stay with that. So stay with bringing in your inflows and the outflows, because the question may not be in such a manner that you will the direct method that you're thinking about will only come in if we are supposed to prepare the statement of financial performance before you prepare the cash flow. And the examiner may just bring a question that you are supposed to prepare a cash flow statement, and for that reason you don't have anything about net operating profit or net operating deficit or surplus for the year. So stay with the default approach. Bring under operating activities, bringing in your inflows. They are revenue, that is tax revenue, non-tax revenue, what the heck that has to be brought. They are expenses, wages and salaries, social benefits, those things. So stay with the default approach. Because that's going to help you more. Okay, so all right, Nana said thank you. Then another question said, can you use the value for money framework to answer the same question? Yeah, definitely the value for money framework. If you remember that, we spoke about that as well. You can use that framework to answer the same question in that particular case. Then Jakamani is saying that touch on capital expenditure, please. I don't understand the context of capital expenditure. Maybe you provide me with some context, then I can provide you with an answer in that regard. What do you mean by capital expenditure? Like, give me some context, and then let me provide you with some answers. If there are any questions, please raise your hand. I bring you up on the Zoom, or you put it in the chat for me if you don't want to talk, okay? some other comments on YouTube. Abdul Razak Al Hassan said, kindly expatiate. Mini Gibrofone. Oh, on Treasury single accounts and the consolidated accounts. Okay. Okay, so the difference between the Treasury's single accounts and then the consolidated fund is that the consolidated fund is the fund is the public fund into which all government revenues are paid and out of which all government expenditure is to be incurred. Okay, so that is the consolidated fund. But you see, when you go to the Bank of Ghana, where the accounts of the consolidated fund is kept, we don't have any accounts called the consolidated fund. So the bank accounts at the Bank of Ghana representing the consolidated fund, which is the national fund for the Republic of Ghana, is the Treasury's single account. So that's the difference between the two. The consolidated fund is the public fund, the default public fund, into which all government expenditures are paid, out of which are paid into, and from which all government expenditures are paid. But then the Treasury's main account is the bank account at the Bank of Ghana, which receives all government payments and from which all government expenses are paid. So that is the difference between the Treasury's single account and then the consolidated fund. So the consolidated fund, like I said, is representing the bank accounts, which is at the Bank of Ghana. So that is the issue about that. Let's see. Over here. Okay, I've had what constitutes capital expenditure, please? Okay, so that is Jacomani's verification or expansion. Now, capital expenditure is capital expenditure. In other words, capital expenditure means expenditure into the acquisition of infrastructure, property, plant, and equipment, work in progress. These all can be capital expenditures. So I don't know, again, we solved a question in class where we were supposed to calculate, we're supposed to deal with a cash flow statement. We're solving a cash flow statement. And if you remember in the trial balance, there was acquisition of property, plants, and equipment. There was work in progress. And we dealt with all that as what? A capital expenditure under the cash flow from investing activity. So when you talk about capital expenditure, we are talking about acquisitions of during the year of the infrastructure, property, plants, and equipment. But if you are answering this question, how do we call it? In the context of ratios, okay, chances are you may not be able to arrive or get the figure for capital expenditure in the statement of financial performance. Okay, so what happens is that is where you're going to be taking your infrastructure, property, plant, and equipment as the capital expenditure when you're supposed to calculate capital expenditure to total expenditure ratio or capital expenditure to tax revenue ratio. So when you ask about capital expenditure, it simply means investment during the year into infrastructure, property, plant, and equipment in that case. Infrastructure, property, plant, and equipment in that case. Then another chat coming in from the comments. Let me know if that makes sense for you, Jacomani. Another question coming in from Stephanie said, can you please explain the role and the authority of the conceptual framework of financial reporting in the conceptual framework in the public sector? Oh. Can you explain the role and authority of the conceptual framework of financial reporting in the public sector? Okay, the purpose of the conceptual framework is to set the rules, the guidelines, and the processes involved, or to set the rules, the guidelines, and the processes for preparers of financial statements to prepare financial statements that represents a true and fair view of the entity. Let me take that again. The role of the conceptual framework is to set the rules, guidelines, and principles for preparers of the financial statements to prepare financial statements that represents the true and fair view of the entity. That is the conceptual framework. Now, its role technically in financial reporting in public sector is simply to assist public sector officers or public sector organizations to prepare financial statements that represent or that possesses the qualitative characteristics of financial statements. In other words, the conceptual framework provides that basis, that guidelines, that principles to be able to prepare financial statements that represents faithfully the entity, financial statements that are reliable, financial statements that are understandable, financial statements that are verifiable, and financial statements that can actually represent the entire entity and its economic phenomenon for the year under review. I don't get a context of the question really well, though, but if you ask about the role and the authority of the conceptual framework, that's what it is. It gives the guidelines, the principles for preparers of financial statements to prepare financial statements that represent the true and fair view of the entity. In other words, it assists the public sector organizations, principal account holders, principal spending officers to be able to prepare financial statements that faithfully represents the entity, that is relevant, and that represents the economic phenomenon that occurred during the year under review. So that is the idea about what I can say in the context of your question for the role and authority of the conceptual framework of financial reporting in public sector. Let me know, Stephanie, if that makes sense for you. Yes, James, your hand is up.
So I want you to throw more light on the fund accounting and vote and commitment accounting.
Now, we mentioned that a vote is simply, a vote is the same as appropriation, okay? A vote is simply a fund that has been approved by Parliament to be used for a specific expenditure. So for that reason, a vote accounting is simply an accounting system where records are kept relating to a vote that has been approved by Parliament. So for instance, if Parliament approved 10 million Ghana cedis for whatever, free SHS, or for NAPCO, or for youth in whatever the heck, entrepreneurship or whatever, that is a vote. That is a vote. That is a vote. So as we spend money from that vote, records we're going to be keeping, it's the concept of what? Vote accounting. The mechanisms involved in recording transaction based on the approved or the appropriation by Parliament. Commitment accounting, on the other hand, is where records are kept or transactions are recognized once they are evidenced by the award of contract or a purchaser's order. That is commitment accounting. What happens then is that, and the purpose of commitment accounting generally is that we want to remove the money from the votes and put it aside because we have awarded the contract or because we have sent the purchaser's orders. The purpose of that is that so that we don't spend the rest of the votes without taking into consideration the contract that we have awarded. So commitment and votes have something in common. So for instance, let's say that the Ministry of Education for the year, their vote is 10 million Ghana cedis. That's their votes. That is what has been approved for Ministry of Education to spend. During the year, if Ministry of Education awards any contract, maybe to procure desks for some schools or to procure some uniforms or to do anything, once they award a contract, the vote that was approved by Parliament for them to spend, they will remove the money from the vote and put it into the commitment account. So that when the contractor or the supplier brings in the goods that they had ordered, then they can now move the money from the commitment account and pay the person at the end of the day, so that the records will now be kept in the expenditure account of the Ministry of Education. So that is the concept also about commitment accounting, where records are kept, evidenced by contracts awarded or purchases order sent out. Then what else do you fund accounting? We said that a fund is an independent account which requires separate books of accounts for its assets, liabilities, and account balances at the end of the reporting date. A fund is an independent account requiring separate books of accounts to represent assets, liabilities, and balances as the reporting date. So for instance, we have the consolidated fund, we have the sinking fund, we have the Ghana Education Trust Fund, we have the road fund. Now we're going to have COVID-19 fund, right? Because once the COVID is levied, whatever the heck has been approved, it's going to go into a separate fund. And by the road minister's judgment, we are going to use that fund to borrow money. So that is also going to be. So what happens is that each of these funds will be accounted for separately at the end of the year, so we can know the balances that exist between them. So that is vote accounting, money that has been appropriated for a specific expenditure. Commitment accounting, recording transactions evidenced by a contract that has been awarded or purchases orders sent. And then fund accounting, keeping separate books of accounts for the different funds of the government, the consolidated fund, the sinking fund, the road fund, and all that. So that is the issue about these types of funds as well in that particular case. Let me know if that makes sense for you.
So thank you. Maybe I'll come back later.
Okay. Okay, I'm seeing another chat coming up. I see some of you guys joining. If you join, you can put your question in the chat for me. I'm going to be providing you with some answers. Or better still, you can raise your hand and I'll bring you up. Let's see what else we got here. What's the name? Please take it again. Treasury single account. Yeah, we said that the Treasury single account is the account of government representing consolidated fund at the Bank of Ghana, into which all government revenues are paid and from which all government expenditures are also paid. So that is a Treasury single account. So it is the account representing the consolidated fund with the Bank of Ghana, that is the central bank, into which all government revenues are paid and from which all government expenditures are paid from or are financed from. Let me know if that makes sense for you. Jakamani said, question answered, said, okay, that's fine. Another chat coming in. Joseph said, good evening, Nhyira. Please, have you touched on how to account for service concession? Sorry, join late, pardon me. Yeah, I've mentioned something on service concession already because it was one of the questions someone asked. The idea we mentioned about service concession is we said it is a type of PPP that requires the private investor to put in money and also manage the public asset for a given number of years. And we said that the grantor or the public sector entity can actually recognize an asset and liability relating to the service concession if the following conditions are met. One, if the public sector entity or government controls or regulates the price at which these goods or services will be provided or sold by the private investor. Or two, if government actually has representation on the board of the entity, then we can recognize assets or liabilities in that regard. So recognition of assets, liabilities under service concession depends on whether government regulates, government controls, and government has a residual interest in the asset. If government regulates their prices, then certainly we're going to recognize assets from the service concession and liabilities as well from the service concession. So yes, we mentioned something about this in the beginning. Angelina said, can you please explain principal account holder and principal spending officer? Sorry. Yeah, we said the principal account holder is the the politically appointed person heading the public sector entity. That is the principal account holder. So for instance, the Minister of Education is the principal account holder for the Ministry of Education. Sounds good? And then the mayor of the Accra Metropolitan Assembly will be regarded as the principal account holder of the Metropolitan, what did I say? The Accra Metropolitan Assembly, AMA, right? So that is the principal account holder, the politically appointed individual or person heading a ministry, a department, or an agency. Note that board of directors can also be principal account holders, because these people are usually appointed sometimes by the president with sometimes parliamentary approval in that regard. So that is principal account holders. Then the principal spending officer is simply the senior most administrative head of the Metropolitan Municipal District Assembly or a ministry, a department, or agency. The senior most administrative head, the one responsible for the day-to-day running of the organization. So if we take a public sector entity, for instance, the board of directors may be public principal account holders because they are appointed, but a CEO is responsible for the day-to-day running, as well as may be appointed as well by the president. For that reason, the CEO can be a principal account holder responsible for the day-to-day running of the organization, and at the same time be a principal spending officer as well in that particular case. So that is the distinction between the two. The account holders are politically appointed people heading the ministry, the department, the agency, the metropolitan, the municipal and district assembly. Then the principal spending officers are the senior most administrative heads of these institutions and these organizations. And definitely they have their roles. And I believe you know that because you did not ask me that. I hope that makes sense for you, Angelina. Seeing some chat coming in on YouTube. Let's see if I can take some. Razak Al-Hassan said, kindly explain sinking fund as well. Right, sinking fund is simply a fund set up by government for repayment of loans. That's the purpose of the sinking fund. It is for repayment of loans. So the purpose is that every year government is going to be making some payments into the sinking fund, and that payment is going to be invested. Okay, that payment is going to be invested. And then when it is time for us to pay or repay a certain loan, we don't go into the consolidated fund and go and suck it up. But instead, what we're going to do is to go into the sinking fund and then remove the money from there to go and what? Pay the loan. So the purpose of the sinking fund is for the repayment of loan notes. And if you ask me, that's what you have to know. Let me come back on the chat here. Stephanie said, Nhyira, can you illustrate how commitment accounting could strengthen public financial management? Can you illustrate how commitment accounting could strengthen public financial management? Oh, yeah. I'm trying to think about it to see how I can answer that question. Oh, my goodness. Let me process that question a little bit. Then I'll give you an answer. Okay, Stephanie, give me some moment. I'm going to process it. Let me take one more question. Then by then, my brain will finish processing it and I can provide you with some answers on that. Because some of these questions, I wouldn't just jump and give you some points. I need to give you some solid points on that. So stay with me. I'm going to provide you with some answers in a moment as I process that underground. Nanefwa said, please touch on the weakest link and the average method under PEFA. Right. So we mentioned that the average method, that is M2, under PEFA is where we are evaluating the performance of the public financial management system of the government using the average method. Okay, using the average method. Now, the average method is where we say that you know the ratings already. A, B, C, D, flipping over 4, 3, 2, 1. Okay, A, B, C, D, flipping over 4, 3, 2, 1. So the idea about the average method is that what happens is that we're just going to be calculating whatever. So if it is budget reliability, under budget reliability, there is transparency of the budget, there is revenue mobilization. So whatever dimension we are measuring under that, whatever rating that is there, if it is A, C, D, all you do is you add their numbers up and divide it by the number of letters that you have, and that gives you your answer. So if the answer is 3, then you know that 3 represents A, B, C, D. 3 represents B. So that is going to be a good public financial management system. That is the average method. So you still follow your A, B, C, D, get your average of that, and that represents whatever measurement you're going to be giving to the entity. The weakest link method is where we are still using the grading A, B, C, D to measure the organization's performance, but this is where we're going to be either bringing B plus or a plus or minus to determine whether a certain system or a certain indicator is efficient or effective. So the same thing as the average method, where we are going to be looking at the ratings available and divided by the average, you're going to do the same thing relating to the weakest link. But the idea is this. In the weakest link, what happens is that a positive dimension in the same indicator will negate off a negative dimension. Or let me take it this way. A negative dimension in the same indicator will write off a positive dimension under that same indicator. That is the weakest link approach. So unlike the average method, where we don't care who is positive, who is negative, we don't care who is 4 and who is 1, in the average method, in the weakest link method, we care about that. So under the weakest link method, a positive indicator can be netted off with what? A negative indicator. So that at the end of the day, let's say you are measuring 3 indicators. One is A, the other is maybe C, and the other is D. What is going to be happening at the end of the day is that A will be consumed by the D, which is the worst performance. So that at the end of the day, we will say that the entity's performance could be the B, which is outstanding, because the negative cancels the positive. That is the idea about the weakest link. A positive dimension is canceled out with a negative dimension of the same indicator. But under the average method, that is not done. We don't do positive, negative. All we do is, what is our average? Then we will use that to determine the performance of the organization. We use that to determine the performance of the organization. Yes, Nane, for your hand is up.
Nhyira.
Yes.
Yeah. A follow-up question on that. So it means that in the average, when you calculate, and maybe there was 2.4, 2.5. Definitely, are you not use that one to do the ranking?
Yeah, we scale down to 2, and then you use the grading for 2. 2 will be what? 2 will be
2, which is C.
C. So it means it's a poor performance. In that case, yes.
Yeah.
Does that make sense?
Yes, but if it's the weakest link, then it will be a C plus.
Yes, it will be a C plus, because we're going to be adding C to it. We will make it a plus there to say that yeah, it's not poor, it's not good, but it's an intermediate performance there. So we'll add a C plus to it if it is a weakest link. Yeah, that is a good illustration there. So we'll add a C plus to it. To add a C plus. Yes, Nana.
Okay, thank you.
Asia, a follow-up on the same average method. My confusion here is calculating the dimensions. Is it the A, B, C, D, which when you flip it side is 4, 3, 2, 1? Is it those figures you're supposed to add together and divide by the average?
That's right.
I'm a bit lost.
That's right.
Those figures.
Yes. So
those
let's
are the dimensions.
Yeah, so let me give an example. Let's say that we are measuring budget reliability. Under budget reliability, there are a couple of dimensions there, like budget transparency, like maybe revenue allocation, like whatever. Let's say there are three things there. So they have whatever. Let's say they're based on the rating given to us, it is B, C, and D. Okay, if it is B, C, and D, we know B is 3. C is what? C is 2, and then D is 1. So it becomes 2 plus 3 plus 1. Does that make sense? Divided by 3. And that is how you get your answers. Does that make sense?
Okay, so in this case, as your answer is going to be 2.
Mm-hmm. So that once you get to 2 is C. So then if it is C, it means the financial management system, the public financial management system relating to budget reliability is poor.
It's poor. It's average.
You get that?
So if it's the weakest link, 2 is going to be C plus.
Yes, C plus. C plus. Or better still, we will look at, because we had B, C, D. So what we're going to say is that, yes, C, we could do C plus there because B, C, D, the B is very, I think, very good. The D is worse. So the D will eat the B for lunch so that we'll be left out with C. And so we can put in there a C plus or something like that for the measurement.
Okay. Thank you very much.
All right. Yes, James, your hand is up.
The follow up with this. I want you to throw more light on the importance and the challenges of PEFA. That's the first one. Then 2, when you are preparing a financial statement for a
Relax. Let me take it one after the other so that it doesn't bust my brain a lot because I'm processing a lot in my head right now. So take it easy. Let me answer the first one. So importance or challenges of, these are 2 different questions you're talking about, but the importance of the PEFA is that it assists the government to obtain a snapshot of the public financial management system, the strength and weaknesses of the public financial management system that is in place. That is the first thing. And then also it helps government in making a lot of planning decisions and improvements in its public financial management system. That is another importance of it at the end of the day. Some challenges that we can talk about is that the PEFA does not take into consideration current government financial management policy implemented and its impact on the financial management that we just measured, because you will measure the 2020, but during middle of 2020, maybe government implemented a new public financial management system, but that will not be captured when we are doing our PEFA assessment for 2020, because the impacts of that will actually be felt in the following year. So it does not provide us with a way to be able to analyze current impact on that. Then another thing is that the PEFA framework itself does not provide ways of improving the PEFA results unless the government of the host country or the country reach out to the secretariat of the PEFA secretariat for directive. So the framework itself doesn't make recommendations. And so that is another challenge or limitation of the PEFA framework, if you ask. So that's what I can say there on that. And then what's the next question?
So assuming you are preparing a financial statement of a covered entity, and in the balance sheet, the book research allowance is there, a figure is there. Then the additional information, they say that, assuming that they say that a certain amount is received or yet to be received from government, how do you treat it?
Yeah, definitely. If it is outstanding to be received from the government, that will go under receivables. So the whole amount will be part of the revenue, definitely. But then if we go to the statements of financial position, we're going to be having that figure in the footnote, which is yet to be received from the government as part of their receivables. So when you go to your receivables workings, that will be added in receivables. Does that make sense?
Sir, but how does, I'm saying, please, if you can come again, what about the one that is paid in the balance sheet? I'm saying, assuming you have a balance sheet, and then there's a figure there, representative book.
How can you have a balance sheet and have a footnote? I don't understand the question. Are you talking about?
Trial balance, trial balance, sorry. You have a trial balance, and there's a figure representing research and book allowance. Then on the additional information, there's a figure, but that figure is more than the one that is in the trial balance. And then they made a statement. Let's now assume that either they say that the one extra, the additional information one, they say it has been paid or yet to be paid. How do you work on
Everything in the footnote must be treated twice. So you add it to the amount that is in the trial balance to be part of their revenue if it has to be classified as revenue, and you take it to receivables as well. So the double entry is to debit receivables, credit your revenue. So what is in the footnote will be added to the revenue in what is in the trial balance, and then added to your receivables as well. That's how you do the treatment.
Simply, how about the expenditure side?
Which expenditure side?
Is it not an expenditure for this thing? Compensation of employee.
The context of the question you asked me, it's a revenue item. So if it is an expenditure item, then you deal with it as an expenditure item as well at the end of the day. Because if I get a context of your question, I don't know the kind of organization we are dealing with. So it will be difficult for me to deal, say.
A university, a public university.
If it's a university, you can deal with it. Then if it is a university, book allowances should be part of their personnel emoluments, definitely. It will be part of the personnel emoluments for the employees at the end of the day. So it means that that amount will be treated twice. Like we said, any benefit received from the government has to be treated twice, once as a revenue and the other as an expenditure at the end of the day. So the amount will be treated as revenue and treated as an expenditure as well.
Okay, thank you.
All right. Who is MB? I don't know. Am I having some people joining my meeting that I don't even know them? Who is MB? If you are seeing who, please explain the three primary objectives of an effective public financial management system. Is it that people are doing quiz or something like that this evening? Three primary, is it primary? Three primary objectives of an effective financial management system. If you talk about, okay, so I think this question has some relationship with Stephanie's. Stephanie's own was commitment accounting. I'm going to come to that in a moment. So give me a moment. Let me just go back to Stephanie's question and take that. Please, can you illustrate how commitment accounting could strengthen public financial management? Yes. Like we explained the concept of commitment accounting, we said keeping records of transactions evidenced by the award of contract or by purchases order, by sending out a purchases order. So one of the ways that this can strengthen public financial management is that it helps governments to provide or set aside funds for all contract or purchases orders that has been issued. Okay, it helps governments to set aside funds for contracts awarded or purchases orders sent out, so that at the end of the day, you don't finish consuming the votes. The supplier has come, brought you the goods, then you don't have the money to pay the supplier. So that is one of the ways that it can strengthen the public financial, or can strengthen public financial management. Another way it can also strengthen public financial management is that commitment accounting helps so that government doesn't make payments for goods that it does not receive or services that it did not receive. That way, value for money is achieved. What is the meaning of that? So, for instance, let's say that the government awards contracts. Now, if we are in vote accounting alone, once we award a contract, you may pay the money upfront or pay something upfront, or be there if the person brings the goods, then we'll pay the money, even though the person may not have brought all the goods, leading to judgment debt. But assuming we are using commitment accounting, we set the money aside. When the person brings the goods, internal auditors would have to look at the purchases order, the contract we signed. If that was the goods, that was the services the supplier or the contractor has rendered or has brought. If that is the case, then we can move the money from the commitment account into the expenditure account. So that is another way also that it strengthens public financial management. And at the end of the year, if there is any amount in the commitment account that has not been spent yet, it is balanced off and then put there as part of our what? Remove from the commitment account into liabilities on the face of the financial position, meaning we've set deferred income, so it's going to be a liability, meaning that we've awarded the contract though, but then we've set the money aside to pay for those things once they come. So if you ask me how commitment accounting strengthens public financial management, these are a number of things that I can share my thoughts on. That yes, number one, it helps us to account for transactions or set money aside in order not to spend the votes. And when contracts are executed, we cannot pay. Number two, it prevents overpayment of contracts or underpayment of contracts because the money set aside covers the contract, all other things being equal. And then number three, it helps the government in order to, at the end of the year, whatever amount outstanding in the commitment accounts will still remain in the accounts of the company and not consumed because that's money belong to a contract we have awarded or a purchase order that has been sent out. If you remember, we said something about one challenges of budgeting. We said spend the budget and spend to the budget. You know, commitment accounting prevents spending the budget. You know, spend the budget means, hey, if government has given us whatever, $10 million, even if we don't have anything to do, we will spend the $10 million. What have we done? We are spending the budget. But through commitment accounting, because you've removed the money from the votes already, the votes may be zero or not having anything. So then you wouldn't be motivated to go and make unnecessary spending because you've set money aside for the expenditure or the contract that has been awarded. So that is the idea about what I can mention and illustrate when it comes to how commitment accounting strengthens public financial management. Let me know if that makes sense for you, Stephanie. Let me take some questions on YouTube. You know, we are also with some people on YouTube. Let's take some questions from there. Yeboah Nana Ekwia Konedu said, good evening, Nhyira. Please, in the computation of non-oil fiscal balance, how do we get the fiscal balance amount? And also in finding net debt, how do we find financial assets amount? The financial assets amount includes your equity investment, okay, that is financial assets, and also trade receivables could be part of financial assets. At the end of the day, cash and cash equivalents could also be part of financial assets. So anything that can be converted into cash, so equity investment, trade receivables, cash and cash equivalents, all these are financial assets. So if you talk about financial assets, that is what you need to understand there. Then you asked about in the computation of non-oil fiscal balance, how do we get a fiscal balance amount? The fiscal balance amount is going to be the amount that is on your statement of financial performance. The net operating deficit or loss is going to be your fiscal balance. And if it is non-oil, meaning that if there was an oil revenue included in the determination of total revenue, the footnote will be given for you on the oil revenue. Then you remove that as well so that you can get a non-oil fiscal balance. So Nana Ikuya Konedu, that is your answer there. Let me go back to Zoom. Got some questions here. Please explain the three primary objectives of an effective public financial management system. Like I said, I'm processing that. I'll come back to you on that, MB. Stephanie said, please, can you explain the public-private partnership and its forms? Ooh, that is a whole topic, Stephanie, you want me to do right now. The public-private partnership, it's public-private partnership. It is an arrangement between a public sector entity.
Nhyira.
Yeah.
Sorry, not public-private. Public-public.
Oh, sorry. In my brain, I'm dealing private. Okay, so public partnership. Like the name suggests, public.
Is that one is coming or what?
Why are you asking? Everybody's asking you a question. When you ask a question, did somebody ask you, is that one coming?
Everything is coming by phone. Everything is coming by phone. Whatever we are saying is coming by phone.
Okay, so public-public partnership is where two public sector entities come together to execute a project. That is not really common in this part of the world, in Ghana especially, but the idea is that two public sector entities come together to execute a project. So let's say, for instance, there is a road that has to be constructed somewhere, and the Ministry of Road and Highways, it's responsible for roads and highways situations. But then that road leads to a community where, if that road is done, I mean, people will be able to attend a school that has been now constructed by the government as well. So in that case, the Ministry of Road and Highway could come together with the Ghana Education Service to construct the road for that particular community. That is a public-public partnership arrangement. Now, the reason for that is that it reduces the burden on each public sector organization, and they share the risks. Just like how public-private happens, the same benefits for two public entities and two public organizations. So that is the idea about public-public partnerships. Public-public partnership. Like I said, that is not too common in this part of the world that we can talk about here, but that is the idea about that. The two entities share their risks. The two entities shares the funding requirements, and the two entities also share whatever benefits that comes out of the project at the end of the day. So that is the public-public partnership arrangement. And then you are saying it forms. Let me see if I can get anything on that in my slide here on PPP as I take that question. So let me see if in my slide I'll have that. It's not something that is common in Ghana, so it's hardly to get forms, but let me see if I can get that on my PPP slide here. Then I can add something. The NEFWA said, please touch on supplementary budgets, environment, and media review. Okay, so we said that the media review is a statutory responsibility. Did I do that well? No, it's a statutory requirement by the Minister of Finance to present to Parliament at least by 31st of July each year the budget implementation for the first half of the year. The budget implementation for the first half of the year. That is the media review. So at the media review, the finance minister is required to inform government or parliament about the budget implementation for the year, and also gives informs parliament if there will be any changes in the financial management or the budget for the remaining year. That is the media review. Now, at the media review, if government is unable to meet revenue targets, government requires additional funding, or there is an expenditure that arose for which government did not budget for, or there is increases in expenditure due to global inflation or global economic crisis, that means government requires additional funding. So if government requires additional funding, then at the mid-year review, the Minister of Finance will submit what is referred to as what is supplementary estimates or supplementary budgets. So supplementary budgets or supplementary estimates are simply budget estimates provided to Parliament for approval, consideration and approval at the mid-year budget review, requesting for additional funding when government is unable to meet revenue targets, when there is increase in expenditure than what was budgeted for, when there is global economic crisis or global inflation, or if an activity happened for which government did not budget for. So that is also the supplementary budget. Viement is simply the concept of using funds meant for an activity to finance another activity. That is viement. But if you remember, we explained the basic principles about viement. Among other things, we mentioned that viement means you are making savings, okay, from one class of accounts, and you use the savings to finance what? Another account or another expenditure for the period under review. You don't make savings, you don't use the money for something else. Nonetheless, the Minister of Finance has the authority to administratively carry out viement, even though there has not been any savings. And that is where the government decides to suspend a certain activity so that the fund meant for that activity will be used for another activity instead. So if you ask about budget, supplementary budgets, viements, and media review, then these are the things that you need to understand in that case. I think I don't have case study student people on the call. If you are seeing who, young guy. Okay, Stephanie said, please talk about the annual budget cycle. Boy, that's huge. Annual budget cycle. My goodness. Okay. Let's see if I'll remember. This is one that you guys are doing me mental this evening. My brain is even not able to encapsulate everything. Okay, so let's see the budget cycle. Basically, when we talk about the budget cycle, it starts with the first stage, that is going to be the budget formulation. If you remember, we said that at the budget formulation stage, among other things, number one, the Minister of Finance and then Cabinet prepares the strategic document, the fiscal strategy document. The purpose of the preparation of a fiscal strategy document is simply to provide us with the economic outlook for the government, the various economic objectives and policies of government for the period under review. And that is the first stage. We formulate the budget, we formulate the strategic documents. Then also at the budget formulation stage, our government determines how much it intends to commit into various expenditure items at the budget formulation stage. Then through that, budget ceilings are going to be issued and given out to the various MDAs, MMDAs, and other covered entities who are going to be requiring funding from the government. Then we come to the budget authorization. Now, we made mention of the fact that when it comes to the budget authorization, this is where the various MMDAs and MDAs receive budget guidelines and then they prepare their budgets. Now, when they prepare their budgets, the budgets that they prepare must be in line with the budget guidelines issued by the Minister of Finance, and also must be in line with the fiscal strategy documents of government. And that is the budget authorization stage. Then we come to the approval stage. And we made mention that the approval of the budget occurs in various forms. Approval of MMDA's budget occur with a resolution by the Assembly, and their budget is then sent to the RCC, the Regional Coordinating Council, who then also by resolution pass the regional budget, which is then sent to the Minister of Finance. Then we also said that the budget office at the Ministry of Finance invites the principal spending officers and principal account holders of ministries, departments, and agencies for a budget hearing. And the purpose of the budget hearing is to enable these principal account holders and principal spending officers to defend their budgets, why you want to spend this money, and also to ensure that the budget that they have prepared is in line with the government's objective and the government fiscal policy. Now, after that, we said the revised budget is then sent to the cabinet, that is the president, for them to look out for it and then see whatever has to be done. Date is set, then the budget is sent to Parliament. Now, once the budget is sent to Parliament, Parliament is going to break up into the various subcommittees of Parliament. There are committees for finance, committees for education, committees for national security, committees for whatever the heck, and they all go in through the various budgets. They issue their reports, and then Parliament do a house hearing on each of the budgets for each of the committees, and the chairman of the committee is going to be reading the report. And once they read the report, if it satisfies them, it achieves value for money, it is going to reduce poverty, it will increase the standard of living of the citizens, and everything is okay, then no, they vote on it, boom, the budget is approved. The budget is approved. So the approval stage, you realize that there are three things there. We have the MMDAs happening with the resolution at the district assembly, coming to RCC, another resolution before it comes to the Ministry of Finance. Then at the central government level, there's the budget hearing that is done for all of the people to come, ministries, departments, and agencies, their principal account holders and principal spending officers to come to defend their budget, to see if their budget is also in line with the guidelines. Then we turn it to the cabinet back, the national budget, for them to look out for. If there is any necessary change that has to be made, they're going to make the change. A date is set, the budget is sent to Parliament, it is read, then it is approved. Then we come to budget execution. I don't know if I'm right on that. Budget execution. With budget execution, this is where we are now implementing the budget, because after the approval of the budget has to be implemented. And so during the implementation of the budget, it is required that various accounts are going to be kept. That is where gift miss is going to come in. And if you remember, I told you to read on that. Gift miss is going to be coming in. Now, don't ask me to talk about gift miss. Gift miss is going to come in for us to keep the various records for the activities. Then during the execution of the budget also, what is going to be happening is that there will be mid-year budget review, and there may be budget estimates, supplementary budget estimates during the execution of the budget. But at the end of the year, the MDAs, the MMDAs, the covered entities are required to prepare their financial statement. And that is where reporting comes in, and they prepare their financial statement. So they prepare their individual financial statements. Their financial statement will be audited by their internal auditors. Then we put out together to now prepare the national accounts of government by the Controller Accountant General. Then we come to scrutiny and auditing. That is where the Auditor General, the boss himself, goes through the national accounts to see if the accounts are in line with the various acts, the various regulations, the Public Financial Management Act and all that. And then at that stage also, PAC will come in, Public Accounts Committee will also come in, check the accounts of governments and do whatever that has to be done. Then we will start the journey again. So if you ask about the budget cycle, I hope I did well on that. Based on what I remember about the cycle, I hope I got the stages right. So that is the idea about the budget cycle, Stephanie. If you ask about that, let me know if that makes sense for you in that case. Let's see. What else do I have? MB said the forms of PUP is the public to public partnership and the public to non-governmental organization partnership. Okay, public. Okay, so you're providing answers to Stephanie's questions on the forms of public-public partnership agreement. And he said the forms of PUP is the public to public partnership and the public to non-governmental organizations partnership. Okay. Okay. Please touch on the justification for adopting accrual basis in the public sector. Oh, that one. I mean, because the accrual basis helps government to prepare financial statement that represents or that faithfully represents the government, that faithfully represents the country. So it enhances faithful representation of the financial statements. Number two, the accrual accounting helps government to account for capital expenditure in line with the IPSAS. Because unlike the cash basis accounting where the capital expenditure will be written off in 1 year, under the accrual basis of accounting, government is able to instead capitalize those capital expenditure and then charge depreciation or amortization over the economic life of the asset or the expenditure. So that is another justification or reason why government adopted the accrual basis of accounting. Number three also is that it's enable governments to plan for the future with reliable data. Now, when you say plan for the future with reliable data, for instance, planning for the future in terms of making borrowing decisions. Because if you are going to borrow, the borrowers, the lenders are going to be looking at your assets. Now, under cash basis of accounting, you're screwed. You're not going to have any assets really on the face of the financial statement because you're written of everything. But then it helps government to know that, okay, what assets do we have? Okay, we have this asset, we have this fund, we have this fund, we can collateralize it and go for this loan. So it helps government also to make decisions as well in that regard. Then it also helps to compare one country's financial statement to what? Another country's financial statement, because they are all under the accrual basis of accounting and they are all applying the International Public Sector Accounting Standards, the IPSAS. So once they are all applying the IPSAS, all other things being equal, we can compare one country's performance to the other country's performance. So if you ask about justification on the adoption of the accrual basis of accounting, these are some of the things I can say on that. MB, let me know if that makes sense for you. Let me pick some messages here on YouTube as well. Yeah, Dom. Nana Equia Connery said, please, can you explain the methods of procurement in consultancy? Yeah. I think that thing is someone's favorite. I don't know. James' favorite things, consultancy. Yeah, there are a couple of methods under consultancy. We have what we call the least cost method. Now, the least cost method is where, you know, we don't really care about the quality of the person who can give us the cheapest price. It is what it is. That is the least cost method. Now, the idea about the least cost method is that these are activities of routine nature that are of small value and whose market price is known by everyone. Are you getting it? So these activities, they are of small value. Their market price is known by everyone. So whoever gives us the lowest price, we go for it. Like you want cleaning services. Come on, man. I mean, cleaning is cleaning. Yeah, you can argue and say, oh, some people, they will use certain things. Forget it. Cleaning is cleaning. And we know if, if someone is doing cleaning, we know how much the average price is. So those kind of jobs, we're going to be using the least cost method to select people. Then we also have what we call the selection based on fixed budget selection. This is where the consultants are selected based on the budget allocation for the particular consultancy activity. So for instance, if government allocated, whatever, let's say $500,000 for that consultancy service, then anybody coming up, we're going to select you based on $500,000. It is what it is. That is the fixed budget selection at the end of the day. Then we have what we refer to as quality and cost-based selection. So this is where we're going to be looking at the person's quality, technical quality of the person, but also take into consideration the cost that the person is charging at the end of the day. So this is where we're going to be giving maybe the quality of the person an indicator of about 80%, then the cost proposal of the person an indicator of 20%. And so we're going to be using both quality and cost though, but then quality will have an indicator of 80%, then the cost will have an indicator of about 20% in that particular case. Then we also have quality-based selection, if my memory serves me right. The quality-based selection is where we're going to be selecting people based on the requirements that we need for the project. Okay, based on the requirements that we need for the project. So if you ask about the methods of procurement in consultancy, list cost, fixed budget, selection based on the fixed budget, quality and cost-based selection, and then quality-based selection. These are some of the methods that we can talk about in the procurement of consultancy. So, Nana Ekia Konedu, let me know if that makes sense for you there. Yes, James, your hand is up on Zoom.
If you can throw more light on this primary uses of financial information.
Okay, so uses of financial information, I think it's one of the common areas that we need to know about. So the uses of financial information includes the citizens. Definitely, you and I, we are interested in the financial performance. The most important thing here is knowing the users and the purpose or the objective for requesting for a given information. So citizens, why do they look for financial information? Certainly for accountability purposes and also to make political voting decisions at the polls at the end of the day. So citizens, that's one of the issues there that we need to understand there. Then the second thing that we need to also understand will be the issue relating to Parliament. They're interested in that, again, for accountability purposes of the executive arm of government, because remember, the budget, when it's approved, it becomes binding on the executive arm of government. So at the end of the year, the Parliament requires the financial information of governments to find out how government has been able to implement the budget. That is why, allegedly, the minority in Parliament keeps asking about how do we call it? How government is using the COVID fund. And they said, yeah, we've used it well. We are still in the woods. Forget yourself. The records are available in the public domain. Go look for it. We ain't going to give you anything. Go look for it. It is what it is. But Parliament needs it. Donor communities also need the information. Why? Because they donated some money to you. They want to find out whether the money is being used for the intended purposes that they donated for you at the end of the day. So they want to find out whether you use the money for their intended purpose. That's one of the reasons as well, users. Then IMF, International Monetary Fund, and then World Bank, they also need this information because they want to make various decisions about whether policies that are implemented and various funds they have donated or lent to you are being used for their intended purposes. The media will take you for lunch. They also need the information. So if you talk about the users, the list is tall. Controller, Accountant General, the Auditor General, the Minister of Finance, Cabinet needs the information. All of these people are some of the things that we can talk about there when it comes to the users of financial information. Does that make sense?
Please, the primary, someone
it's a romantic network.
May say, Maza, fix your network. Please give me a moment. Let me grab water.
For the
Water
secondary users.
Give me a moment.
Hello. Hello, sir.
Okay. James, your network is dancing. I can't hear anything.
Yeah, I'm saying that the primary uses, how is it different from the secondary uses of because it's important.
Oh, okay. Your concern is about primary and secondary uses. Huh.
Public sector normally has.
Let me say this. Normally in the public sector, we don't have that kind of primary, secondary, or intermediate, like whatever. But the idea could be, yeah, primary uses of the public accounts or public information. We could talk about the cabinet. We could talk about parliament. We could talk about the budget office at the Ministry of Finance for budget decision. We could talk about the National Development Commission for making national plans for the country. And also we could talk about the citizens. Because in the public sector, I don't know, we hardly have that thing like primary and secondary situation coming in. I stand to be corrected though, but we hardly have that. Yeah.
Yeah, I think per the ICA manual, they differentiate between the primary users and the other users, and they say that the primary users are the resources providers and the service recipients. So
okay,
yeah.
So just like what the examples I gave out. So like the citizens,
yes,
parliament,
the parliament,
the executive. Okay.
No, I the classification the executives and the executive they are the other users because they received the resources from the providers and they use it. They use it, so that is how they classify.
Okay, so they have the primary users, the other users. Primary users as providers of the resources. Providers of the resources are the primary users, and the service recipients. Yes, okay.
Yes, sir.
Okay, I get it.
Yes, sir.
I get it. Okay. So then in that context, then definitely citizens will be primary users. I mean, donor communities will be primary users. Lenders will be primary users because these people provide the resources. Then the other users will be the other ones. Okay. Thanks for the clarification on that one, on the users. What else do I have? And therefore, I said single source and sole source, two stage tendering and competitive tendering. This one, you're just asking me to do methods of tendering right now. What is that?
Is your This is my only survivor.
Okay, so let's share some thought on that real quick in that particular case. Sole sourcing, sole, one person. So in sole sourcing, it is a procurement process where the goods or services required is available from only one supplier in the whole world, in the whole country. Sole sourcing, that's all. So it is where the procurement entity procure the goods from a supplier because that is the only supplier doing the thing. Like the that blood thing they were doing. What's the name of the company again? Zipline, right? Yeah. The Zipline contract like this, more or less like a sole sourcing because they said the whole world, there is no company doing that thing. That's sole sourcing. Does that make sense? So with sole sourcing, we have only one supplier providing that goods or services. But in single sourcing, there are more suppliers. However, the procurement entity decides to procure goods or services from a particular supplier. That is single sourcing. Now, there are reasons why an entity may go for single sourcing. Why? If it is a repeated purchases, because we've already bought something from them and we are buying an additional one. What the heck? Why do go through procurement processes? Just procure from the person. That's it. 2, if the procurement entity doesn't have time to go through the procurement processes, we do single sourcing, then we go away. Or 3, if it is an emergency, so we are in the middle of a pandemic, it's not now that we have to go and bring things in parliament, procure, advertise. No, just select one person and go away and give us the service. So that is the difference between sole sourcing and then single source. So sole sourcing, only one supplier available in the country or in the world doing that thing. But single source, there are other suppliers though, but the procurement entity decide to procure goods from a particular or a specific supplier out of the pool of the available suppliers. And there are reasons why they go for that, which I've explained. Note that for a procurement entity to use it as single source or sole source, they require a parliament. Did I say parliamentary? They require approval from the Public Procurement Authority. Okay, so they require approval. So they must write to the Public Procurement Authority for approval. Boom, then they can go for it. So that is the issue about single source and sole source. Two-stage tendering is a tendering process where the tendering process is divided into 2. Now, the two-stage tendering is used when the procurement entity is procuring for goods or services but lacks the detailed specification of those goods. Okay, but lacks the detailed specification of those goods. For that reason, they break the procurement process into 2 stages. In the stage 1, the procurement entity invites bids from suppliers exclusive of cost proposals. Exclusive of cost proposal. So the tenders and the bids that will be sent by the supplier is just giving us specification. So for instance, like I use the example always, let's say Ghana Education Service wants to procure some, whatever. What can it procure? Let's say they want to procure some tablets or maybe some iPads for students in the senior high school or in the JHS, but then they don't know. Okay, we want to procure iPad. What kind of iPad do we procure? Should we procure those old iPad with the middle fingerprints, or we should procure the iPad 2020 or iPad 2021? Okay, even the specification. Should we procure 128, 512, or the 1 terabyte size? Like, do we procure the one that supports SIM card or the one that doesn't support SIM card, only Wi-Fi? They don't know, but they want an iPad anyways. So what they're going to do in the first stage is that they will just advertise, hey, all suppliers selling iPads. Guess what? We want some iPad for some university students, or sorry, for some high school students or JHS students. What you got? Come tell us. So that is the first stage. So once they receive all of the specifications, then they can now put together what they think will be okay or will suit the class of the purpose for the iPad. And that is where the second stage comes in. So this is where the procurement entity now publish a tender document inviting bids, so that now the suppliers will include both the cost proposal and then the specification and details of supply in the cost proposal. That is the two-stage tendering. That is the two-stage tendering. I hope that makes sense. And then competitive tendering is competitive tendering. You feel me? It is a tendering process where the procurement entity opens it up to a lot of people. But if you remember, under competitive tendering, there are 2 things that we need to know about. We have the limited competitive tendering, and then what else? Is it open or international competitive tendering? I don't know, something like that. What the heck do we have?
Sir.
International.
Okay, thank you. So limited competitive tendering and then international competitive tendering. So in the international competitive tendering is where we allow foreigners to bid also for the contracts at the end of the day. And then there is a domestic or local tendering where we only allow locals or domestic companies in the country to bid for the contract. Please note that in the Public Procurement Act, there are threshold amounts for methods to be used. So I don't know if that is going to come again. The examiner has asked that before, but it will be good. I showed you this. Go to the Public Procurement Act, and at the bottom of the Public Procurement Act, in the last part, you will see the various threshold and the methods that is appropriate. So under competitive tendering, we are going to be having, yes, Martin. Yes, Martin, your hand is up.
Yeah, Nhyira, please can you just elaborate on the pre qualification?
Okay. Okay.
Procurement.
All right. So let me finish with this one. So under the competitive tendering, yes, it is where we are opening the pool to everybody to come as much as we can. But under that, we have the restricted tendering, where, I mean, even though we are opening, it is restricted to a certain number of people who can bid for the contract at the end of the day for the period under review. And so when you talk about single source, sole source, two-stage tendering, and competitive tendering, these are the things that you need to understand in that particular case. Then, Nana Efua, let me know if that makes sense. Then pre-qualification. We mentioned that in some cases for as part of the tendering process or the competitive tendering process, after we publish the tender document, the procurement entity may undertake what we call a pre-qualification. Now, pre-qualification is where before suppliers submit their tender documents, we made them provide their qualification to see if they meet the criteria even before they submit what their tender document. Now, the purpose of the pre-qualification is to reduce the entire review process so that only people who qualify. So let's say we've set a criteria. You're supposed to have a certain capital. You're supposed to be in a business for a number of years. You're supposed to have a certain number of employees. You are supposed to have a certain tax payment period, all that. So that is the idea about pre-qualification. It is a process and that may be undertaken by a procurement entity to examine suppliers, contractors, or consultants based on their qualification and the criteria published in the tender document before they send or bring in their proposals. So that is the issue about the pre-qualification. Martin, let me know if that makes sense for you.
Okay, thank you, Nhyira.
Right. Stephanie said, please, can you talk about some risks associated with the use of single source procurement? Yeah. I mean, there are a couple of risks there. Value for money may not be achieved under single source because, I mean, we may procure the goods at a high price at the end of the day. So that is one of the risks associated with single source because, I mean, if there are a lot of people, but you decide to procure from somebody, he may charge at a higher price at the end of the day. So value for money may not be achieved. That is one of the risks. Then the single source is also exposed to some corruption as well, which also affects value for money ultimately at the end of the day. So that is another risk associated with it because it's like who you know is who you go for. Because for instance, let's say, now this is just an example. I'm on YouTube and this is going everywhere. So this is just an example. I'm going to take it anywhere. Let's say, for instance, the Electoral Commission is looking for an internet company. All right. There is Airtel, Tigo, there is Vodafone, there is Zipline. Did I say Zipline? Surfline and whatever other. And there is MTN. But then the deal was given to MTN. Okay. What the heck? All right. MTN is the biggest. Okay. National coverage. Okay. I don't know. Maybe some lobby can go on there. So when there is single source coming in, I'm not saying there is lobby. That's why I clarified that. Disclaimer. Some of you have to be careful. So it could result into a lot of political or corruption that again affects what? Value for money at the end of the day. So that is also another risk that is associated with using the single source. So value for money may not be achieved because we may procure the goods at an expensive price. Then two, it may result into corruption. The third thing is that it may result into procurement of less quality or shoddy goods or services. Because probably, again, because we know the entity or we know the owner of the entity, we procure the goods from them. They are not the best, but we procure anyway. So there another risk associated is that we're going to be procuring less standard or less quality goods. Again, that affects our value for money at the end of the day. So these are some of the risks that are associated with the use of the single source procurement method. Let me know if that makes sense for you, Stephanie. Let's see if I can get some things here on YouTube. Bright IET said, sir, please explain to us how cost of service, operational capacity, financial capacity affects the general purpose financial statements. Cost of service, operational capacity, financial capacity affect the general purpose financial statement. No, I don't understand the question really well. Prince of Osoeje, hi. Kindly touch on the methodology M1 and M2 on PEFA. Unfortunately, we've already spoken about that. M1, the weakest link, we said it is a method where a positive dimension in an indicator, it's negated by a negative dimension in that same indicator. But then the M2, which is the average method, it is where we evaluate the efficiency of the financial performance of the public financial management system of the entity by looking at their rating A, B, C, D, flip over 4, 3, 2, 1. We've spent time to answer that, unfortunately, before you came. Maulasi Mukeka said, this is wonderful. Okay. Yeah, Domnane Ekia said, thanks, Nhyira. Okay. Nhyira, can you kindly touch on disposal of public stores and vehicles? Okay, that's about procurement, right? Yeah, so in the disposal of government stores and vehicles, we said there are processes that we go through. Number one, we said we constitute a board of survey. Now, the purpose of the board of survey is we establish a board of survey. And now the board of survey shall be a representative of all government institutions or government departments with surplus stores. Then they will also have someone from either finance or something like that on the board of survey. Now, the purpose of the board of survey is for them to suggest the appropriate means of disposal of their government stores. Now, after their recommendation, the principal spending officer of the entity is going to be approving whatever recommendation they gave. Then the government stores could be disposed of as per the guidelines given by the board of survey. It could be buried, it could be burnt, it could be transferred to another government entity or government institution or whatever. It could be donated as well or given out to someone else. So this is what you must understand about disposal of government stores. So we constitute the board of survey. The board of survey suggests the appropriate means of disposal of their government stores. Then their recommendation will be approved by the principal account holder, definitely of the entity, principal spending officer or the account holder of the entity. Then whatever appropriate means, if it is by disposal, if it is by unction, if it is about bearing, they get rid of it in that particular case. So that is the issue about government stores. Nana Ekia Konedu, let me know if that makes sense for you.
Sir, please follow her. What is a government store?
Government stores are government stores. Goods procured to be used either by the government or for it to be used in the day-to-day running of the entity or for distribution. It's like inventories. So if we buy whatever, office papers, we buy nose masks, we buy mosquito nets, all these are government stores and they can be sold or they can be used by the entity. So at the end of the period, if there are any surplus, unused or expired goods, we need to get rid of them, and that is where the disposal comes in. Then let's see. MB said, the National Health Insurance Scheme is a social intervention program introduced by the government to the National Health Insurance Scheme. Who is MB Krapwa? I don't know any MB in my class. Or somebody is using his husband or his wife's machine to join my meeting. And because I'm doing free range, I'm allowing everybody without non
Illegal migrant.
Who is this MB Krapwa? Let me read the essay the person wrote for me. The National Health Insurance Scheme, NHIS, is a social intervention program introduced by the government to provide financial access to quality health care for residents in Ghana. Required. The ultimate a question pana what to you. Discuss the procedures that should be undertaken to ensure value for money in the implementation of the National Health Insurance Scheme. Discuss the procedures that should be undertaken to ensure value for money. I have to think about that a little bit. So give me some time. Let me think about that a little bit. And then I'll provide you with some answers there. Let's see. Any other questions coming up for me? Stephanie said it does. Thank you. Okay, you're welcome. Thank you. Okay. Any other questions? You raise your hand, I bring you up, or you put it in the chat for me. Let's see if I have something on the YouTube. Yeah, Domnana Ekia said, thanks, Nhyira. Okay, you're welcome. Okay, so it means my whole class here is PSA. Okay, no case study people. Wow, that's nice. I mean, the case study people, we've done whatever we have to do for them. So thank God they are not here. So let me go back to the question. Discuss the procedures that should be undertaken to ensure value for money in the implementation of the National Health Insurance Scheme. Wow. To achieve value for money. This question is open from various things. So it doesn't, because I can give you a certain perspective that will be different from another person's perspective. But let me see. I'm going to think about that a little bit and then provide you with some answers, MB, as we continue. Okay. Namone, Robert Yaboa, activity-based budgeting. Like the name suggests, is a budgeting system or budgeting approach or a budgeting process where the budget is prepared based on the activities that government intends to undertake under each program for the budget year. Okay, under each program for the budget year. That is activity-based budgeting. It's more detailed in nature because it means that we're gonna be like, let's say for instance, when you pick one district, one factory, what are the activities involved in one district, one factory? Like we prepare budgets in detail, like for each of the activities, and that is more detailed at the end of the day. So Kwame Robert Yaboa, sorry, activity-based budgeting. That's what you need to understand there in that regard. Any other questions for me, please? Any other questions for me? Oh, we are good. I can go and sleep. So then let me go and sleep and leave you.
Davi, you can't sleep.
Hey,
Go back to budgeting. Zero-based budget. Please touch on the zero-based budgeting and those things.
So you're now finding a job for me, just like that.
This is my only survivor. Why?
Okay, so when you talk about zero-based budgeting, it's a budgeting system where the budget starts from scratch. In other words, items are justified before they are inclusion into the budget. So the zero-based budget is a budgeting system in which items to be included in the budget are justified before they are inclusion in the budget. Before they are inclusion in the budget. So under the zero-based budgeting, what is going to be happening here is that the entity is going to be looking at the various decision packages available. Like, what do we want to do in the budget period? Then they will look at the various costs attached to all of those decision packages. Then number 3, we assess we analyze based on the priority of government. So maybe during the budget period, what government wants to look out for is to look out for whatever. It wants to do free SHS. It want to do NAPCO. It want to do youth in agriculture. It want to do whatever the heck, some policies cry. I don't even understand whatever the heck they are doing though, but like whatever policy. So we attach cost to it. Then government set priority. In the next year, what should we focus on? Okay, people are not employed, so let's focus on creating jobs. So let's do use that. NAPCO and Koye, let's stop it. So we prioritize, then we justify that. So that is the concept of a zero-based budgeting. The budgeting process is start from scratch, and items to be included in the budget are justified before their inclusion in the budget. That's the zero-based budgeting. Then, what else did you say? Incremental budgeting is where the budgeting process is done, or it's begin with by starting with the how do we call it? Previous year budget. So the previous year budget becomes the basis for the preparation of the current year budget of the organization, where provision is made for economic changes like inflation and other items. The limitation of the activity-based budgeting usually, for the incremental budgeting is that error in one budget is likely to be carried into the subsequent year's budget because of the fact that we just carry the amounts into that year. Then another thing also is that the entity may provide for an item which was necessary in the previous year but will not be necessary in the next year for the period under review. So that is also another thing that we can talk about under incremental budgeting. Program-based budgeting is where the budgeting system is prepared, or budget is prepared based on the various programs that governments want to undertake, which is what this government uses a lot of the time. And this is where we are looking at whatever programs we are undertaking, youth starts, free SHS, whatever. What else do they do these days? One district, one factory, and all of that. And based on that, the government prepares the budget for each of the programs that it is undertaking for the period under review. So, I mean, these are the issues about the methods of budgeting that we need to know about if you ask about methods of budgeting. Let me know if that makes sense. Yes, James, your hand is up.
To throw more light on this thing, expenditure control system in public sector, and also the characteristics of a budget.
We said that characteristics of government budget, we spoke about the fact that it is binding on the executive arm of government. That is one of the characteristics of the government budget. It is binding on the executive arm of government because once it is approved by the parliament, it becomes a legal document that is binding on the executive arm of government. Then another characteristics of the budget is annuity. That is, the budget prepares usually represents government's expenditures for and revenue generation for the next 1 year, even though the medium-term expenditure framework is what is used. Like, even though it goes beyond 1 year, it actually relates to 1 year at the end of the day. That is also another characteristics of the budget that we spoke about. And then what else? Me a few. Me a mentor teacher. When I was in high school, our English teacher, every time we see him, then we are
expenditure, control expenditure in public sector. Waste.
Okay. So let me look at that as well for you. When we were in high school, our English teacher, every time we when we see him now, we're going to ask him, say, your English teacher, what's the meaning of this word? Then one day he caught me and he whipped my buttocks very hard. He said he's not dictionary. So if you are looking for a word, go and look at the dictionary and don't come and ask me because I'm an English teacher. So I think the characteristics, I don't know, I just remember 2 of them. Check your notes for the rest. Expenditure control by government. I think we spoke about a number of things like issue of warrants. If you remember, we mentioned that warrants are documents issued by covered entities for demanding or requesting payment for contracts awarded or goods that have been purchased at the end of the day. But there are 2 types of warrants we must understand. We have the general warrants and specific warrants. The general warrants are warrants issued requesting for expenditure on traditional items expected from them, like requesting for payment for wages and salaries, requesting for payment for office stationery, requesting for payments for day-to-day running of the organization. Those are general warrants. They cover those items. But we also have specific warrants. These are warrants that are issued requesting payment for specific projects, specific undertakings, or specific activities of the entity. So warrants is one of the ways government controls public expenditure. Then number 2, we spoke about across the board cuts. This is where if during a period government realizes that it is unable to meet its revenue targets or it will not be able to meet its revenue targets, then government will cut budgets approved by parliament on certain percentage, like the way recently it was done by the Minister of Finance, announcing that government will suspend 20% of all expenditures across. That is across the board cuts. And the reason government does that is it's unable to maybe raise revenues that are expected to be raised. For instance, one of the huge source of revenue allegedly for government was the e-levy. So they expected that the e-levy will be approved so that by now, January, they would have collected, February, they would have collected, and then March, they would have also collected. But now, because of the back and forth, and now it has been approved, and per the guideline from the Minister of Finance, government will start collecting it in May, I think first week in May or so at the end of the day. So if government is unable to meet its revenue targets or is expected not to be able to meet, then across the board cuts may come in. Then we may also have freezing of votes. Now, freezing of votes comes in as a model or way of controlling expenditure where the Minister of Finance, through cabinet, issues an executive order or directive to the Controller Accountant General to suspend payment of all warrants that has been sent to them. So freezing of votes. Now, again, the reason government does that is to build reserves in order to meet a certain minimum reserve capacity, maybe to go for a loan. As this government borrows a lot, it is what it is. And so bondholders or lenders will want to see, well, what's your surplus cash available now? What's your reserve available now? So based on that, government during a certain period will freeze votes. So you will hear that organization will say, they said we should bring our warrant. We've sent a warrant to the Ministry of Finance. We've been there. They say they are looking at it. They have not paid it yet. It's called freezing of votes because we are building reserves so we can go borrow some money so we can run the economy for you, boys. So that is it. Across the board cuts, freezing votes, issue of warrants. And then there is a 4th one. It's not common. I don't know. Who remembers that? Maybe you can tell us about it. Who remembers that? There's a 4th one on the central. Yeah, thank you. Quarterly limits. That is also another way we control expenditures. Now, quarterly limits is where instead of giving the money to the ministries, department, and agencies or the metropolitan, municipal, and district assemblies at the beginning of the year, we said, hey, hold on. We're going to give it to you at the end of every quarter. That way, you're going to be judicious about its spending at the end of the day. Because, I mean, if you give the money, boom, to them, they can chop it by heart. But then if they realize that it comes every quarter, and even allegedly, Some don't even come at all. Then if you receive small one, you will spend it judiciously and you achieve value for money for the country generally. So these are some of the things we can talk about how we control expenditure from the central government perspective as well, from the central government perspective. Let me know if that makes sense for you.
Thank you.
All right.
Thank you.
Okay. Any other questions for me, please? Let's see. Yeah, let me go to MB's question back. Discuss the procedures that should be taken to ensure value for money in the implementation of national insurance scheme. I'm trying to, like, I have a couple of points that I want to talk about, but I'm also looking at the context pretty well, because value for money, oh my goodness, something just came in my head though, because discuss the procedures to be undertaken to ensure value for money in the. I'm just looking at the context of the question so that I'll be able to provide you some answers that will make sense for you to be able to write at the end of the day. Okay. Give me a moment. Let me just go back to this question. Okay, there's another question I have there. Primary objective of effective public financial management system. Okay. Primary objective of effective public financial management system is to ensure value for money is achieved, or ultimately is to ensure value for money is achieved on all government expenditure. Because if we have an effective public financial management system in place, value for money is going to be achieved. That is one of the things that we can share our thoughts on. Then another objective on effective public financial management system is also to control government expenditure. To control government expenditure. In other words, talking about government's fiscal discipline, so that government raises money and not spend it all or spend within the budget, or government borrows money and not use the money for things that are not supposed to be used for at the end of the day. So if we have an effective public financial management system in place, it helps us to what? Control expenditure and also control fiscal discipline of the government. That is another thing about effective public financial management system that we have at the end of the day. So value for money, control of public expenditure to achieve fiscal discipline for governments. Another thing also that we can talk about is, let me see in my slide here, if I could have something about that. Give me a moment if I can get a slide here on that. Oh, that will be under. Okay. Let's see. Any other questions for me? Asana yenkodao. Na minya meda make minya ndaye so. Yes, ma.
Please, the question MB was talking about, he said the 3 primary objectives. So wouldn't it be the elements of the PEFA?
Let me
Aggregate
see.
fiscal discipline, strategic allocation, and efficiency. He asked the question earlier and he repeated it again.
Oh, okay. Let me see. Yeah, definitely fiscal discipline, which I mentioned earlier. Then value for money, which is the context of allocation of resources that you spoke about, because that is part of value for money. Then what's the third one? If someone has the third one.
Service delivery.
Efficient what? Service delivery.
Service delivery.
Okay.
Yeah.
Okay. So yes, fiscal discipline. I mean, ensuring that government, like I mentioned, I mean, doesn't spend too much than it's supposed to spend. I mean, because I mean, if you have your president flying around in luxurious jets, allegedly, and you know, I don't know which president is traveling around the world though, but it is what it is. It's part of fiscal discipline, so that if you say the country is hard, you stay inside. No traveling, Zoom calls, so we are doing. Then that's fiscal discipline. And then the efficient allocation of resources, it's what I mentioned under the concept of value for money. Because if we are looking at efficient allocation of resources, definitely we're looking at what's value for money. Are we procuring the resources at a least cost? Are we obtaining the best possible results at the end of the day? And are the resources used for their intended purposes? And the people who need the resources, are they getting its equity or equitable distribution of the resources as well? And then effective service delivery at the end of the day. Because I mean, if we have an effective public financial management system in place, then whatever service that will be rendered will be of the best, because there are systems in place to ensure that goods are procured right at the best qualities, goods are distributed in a manner that they are expected to be distributed at. Thank you, Stephanie, on that one. Can strategic allocation of resources be an object? I think we've spoken about that, right? Allocation of resources, it's one of them. Yes, it could be an objective, MB. Could be an objective. Okay. Let's see. Do I have anything on YouTube? Let's see. No, nothing on YouTube yet. Okay, you are welcome. MB. Okay, so I think that's all. Let me share my overall thoughts with you, and we can call it off for the day. Like I mentioned, if you get to the exam hall, you want to start with your written aspect of the questions. Technically, you want to start with a written aspect of the questions at the end of the day, and you read the questions well. We're going to have 10 marks on public-private partnership and arrangements. We don't know what the heck is going to come from there, but the types, the principles, the objectives, the limitations, yeah, easy. I mean, the types, if you remember, we said BTO and then BOO. No, BTO and then BOT. BTO and BOT, they are opposite guys. Then MO, maintain and operate and service concession, are also two opposite guys. Make sure you understand the types. Then the principles, there are a lot of them: transparency, value for money, risk allocation, rights of the users, then ability to pay. Like, understand them very well. The limitations are there, the objectives are there. 10 marks is going to come from there. Then Public Procurement Acts or public procurement, we know 10 marks is going to come from there. We don't know where the heck it's going to be, but if you remember, I told you that issues about consultancy, just can't read that because it's something that examiner had not really shared his thoughts on. So you want to make sure you read that pretty well as well. Then the concept of established practices where a procurement entity can procure goods, works, or services without using the Procurement Act, but procure the goods as though the way your friend is saying traditional or private entities procure their things at the end of the day. And then the methods of procurement, the reasons for each of the methods. I mean, make sure you go through that very well. Then most importantly, revenue management and expenditure control. If you remember, I said either we're going to have a question on that or there may not be any question on that, but the principle for that will help you in evaluation of financial statement ratios and then the preparation of the final accounts. We don't know what the heck the examiner is going to be bringing, whether it's a consolidated fund, it's for a district, it's for a school, whatever it is, the rule is the rule. Understand the way the footnote is going to be treated. Make sure you go over IPSAS 17, property, plants, and equipment, IPSAS 12, inventories, IPSAS 19, and IPSAS 9, And then IPSAS 23, revenue from exchange transaction, revenue from non-exchange transaction, how we deal with them. So these 4 IPSAS are take away IPSAS. You want to make sure you know them pretty well. Then certainly under revenue management, there is internal controls. It has come before, let me say that, I think last semester or last 2 semesters though, but then internal control over cash, internal control over revenue, internal control over expenditures. You make sure you spend some time about those ones also in that case there. Then you come to the issue about the PEFA, all right? Yeah, the examiner has said 10 marks is going to be there for us. So make sure you understand the PEFA also well. Over the last 2 examination dates, the examiner has been bringing the ratio calculation aspect of the PEFA, but then there is also a written aspect of the PEFA. So he can ask you to explain the 7 pillars of the PEFA. So you make sure you understand them in a summary form, put it in your own words, not, quoting word for word, understand the overall thing, then you know how to answer it at the end of the day under the PEFA, and you should be good in that particular case. Then most importantly, how we use the PEFA to assess the performance of an organization. And we illustrated that during our revision session and explained the way you analyze an organization's performance using the PEFA. Then we come to the issue relating to the financial statement preparation, and certainly conceptual framework for general purpose financial statement. Before that, conceptual framework for general purpose financial statement. We said question 1A, 10 marks will be on either measurement basis, accounting techniques, or accounting concept. Question 1A is reserved for that, 10 marks. So it's one of the areas that you got to be on the lookout for. If measurement basis will be there, either the examiner will just ask you to write footnotes or explain the measurement basis, or better still, the examiner will ask you to maybe write on, he will give you a scenario, then he will ask you how to recognize them based on the measurement basis that are available. So make sure you familiarize yourself with that also well. Then I told you also about the qualitative characteristics of financial statements, that it is something that the examiner has not set questions on really in the past. So you can look at that. Then users, I think we asked about that, or we mentioned that you also look at that. So question 1A, it's a free bonto area for measurement basis, accounting techniques, or something relating to the accounting policies when it comes to cash basis, accrual basis, and all that. So that's a 10-mark area free. You know the examiner is going to be bringing a question on that. So make sure you go through that pretty well also. So approach the written aspects first. Okay, make sure you approach the written questions first. That is my recommendation to you always. Then after you deal with the written aspects, then you can now come to your ratios to find out what the heck is going on there. Are you supposed to do common size analysis? Remember, like I said, all the 3 has been examined before. Common size analysis has come before. Ratio analysis has come before. Budget variance analysis has come before. Under the budget variance analysis, that is where the PEFA is used to assess the organization's performance based on, and that is what I think last semester also, that was a budget variance analysis. I think so that came. So ratio analysis, calculation of all the ratios, whatever. That is a broad area. But my concern to you is this, that under ratio, you have to understand, if you're comparing 2 countries, your choice of words have to be different. Because if you say, oh, the debt to equity, did I say debt to equity? Debt per capital has increased. Nothing is increasing. You're comparing 2 countries, right? So you're going to be careful. If there's 2 countries you are comparing, then nothing is increasing. Then country A's debt to equity, debt per capital is higher than country B, or country B is lower than country A. But if it is the same country on the consolidated fund of Ghana, and we are dealing with 2 years, then definitely you can say it's increasing, it's reducing, or whatever the heck is going on there in that case. So that is also something that you need to understand about the interpretation. Please be mindful about the guiding principles when you are analyzing the entity, because there could be reasons why certain things are rising or certain things are falling. Revenue generation is primary. So if the entity is not generating more revenue internally, then their debt per capita may be rising, because if they are not generating more revenue, where should they go? They got to go and borrow. So revenue generation is going to be key there. Then internally, then tax compliance, because sometimes maybe citizens are not just paying tax. Why are they not paying tax? Because they said they don't see what the money is used for. Okay, when we start jailing people, then there will be compliance to pay the tax. So again, tax compliance by the citizens could also be an indicator for us to use for our interpretation. 3, expenditure on personnel emoluments, interest payments, and then goods and services. These 3 items consumes a lot of government expenditure. So if government raises revenue and uses majority of the revenue to finance these 3 items, then it has an implication on social benefits. It has an implication of standard of living of the people. It has an implication on how much money government must raise externally through debt, Eurobond, and whatever the heck, in order to achieve its objective at the end of the day. So what are the measures we are putting in place? Revenue generation, tax compliance, expenditure on personnel emolument, goods and services, and then interest repayments. These are going to be fundamental issues that you are going to be using a lot when you are interpreting the financial statements in that case. So know when to say what. That's going to be my take. Know when to say what. Again, if donation is reducing, donation could be one of the things also, which is part of revenue generation. If donation is reducing, there are a couple of reasons why donation could be reducing, because probably the government doesn't want to now depend on donation, because donations always come with conditions attached to it. So government doesn't want to abide by the conditions, so it stopped relying on donation. Or the donor communities are just tired of donating. Like this government, IMF give you money, then you come and lie about the money IMF gave you, and it has to take the IMF to come and clarify that, because a small little boy country like Ghana cannot lie on the IMF. So they have to come and remove their mouth and say, hey, Ghana, we didn't give you that money. We gave you more than that. Why the heck are you lying to the people? So probably the donor community or the donors are just tired. They don't trust the government because of corruption, because of embezzlement of funds, because of luxurious spending. So they are like, we ain't going to give you money again. So that could be a reason why the donation could be falling. So I don't know which spot you will be on, like based on what will be asked in the exam hall, but it depends. Now, the way you can make the decision is, if, for instance, tax revenue is rising over the years and donation is falling, then you can say, okay, maybe government is relying on internally generated fund rather than the donation. But then if the tax revenue is falling and donation also is falling, then it's smelling, because probably it could be due to corruption. But when you're explaining those things in the exam, you got to be careful, because you need to know your choices of words to use to really clarify what exactly you are saying at the end of the day. But that is also another basis we can use for the analysis. So I'm just giving you the general guidelines that we can use revenue generation, we can use tax compliance of the citizens, we can use expenditure on personnel emoluments, goods and services, interest expenses to determine whether we are doing well or we are not doing well. Okay? These are some of the things that will be the primary issue. Then remember what I told you. If you're analyzing the financial statement, make sure you follow the pro forma. Okay? If it is a report, to, from, subject, date. If it is not a report, the examiner just says, analyze the financial statements for the entity or for on the consolidated fund, then you put your heading down. Then your introduction should be sweet, simple, straight to the point. What the heck is that? The purpose of the analysis, the ratios that you are using, please go back to go and check the categorization of the ratios. We have financial performance ratios, financial position ratios, financial conditions ratios. Know the categorization so that you can use them in that manner in your analysis, because you're going to get a thumbs up from the examiner if you're able to do that clarification very well. So your intro, after your intro, then you pick the ratios one after the other. Like I say always, it will be prudent for you to try to explain the ratios together. Do you understand it? So you try to explain the ratios together in that manner rather than talking about them individually. So when it comes to the financial performance ratios, the financial conditions ratios, the financial position ratios, you explain them together using those keywords that we have spoken about: revenue generation, tax compliance, expenditure on personnel emoluments, wage, interest expenses, and then goods and services. Then you can look at that. And remember the implication of each of those things on the citizen. Because if debt per capita, for instance, is rising, in the future, we're going to screw up the generation, especially if the debt per capita is rising, but the capital asset per capita is falling. Now, capital assets per capita is the infrastructure, property, plant, and equipment, the ratio of that to the citizens. If that is falling, but the debt per capita is rising, it indicates that even though government is borrowing a lot, it is using the money for revenue or recurrent expenditures, which means that there may not be future economic benefits, there may be future economic hardship, and the standard of living of the citizens will fall in the future. Why? Because you borrow a lot, but you don't have nothing to show for it because you didn't in your NUM in that regard. So these are the guidelines about the ratios interpretation that you have to be mindful of. Okay, even if you are interpreting the PEFA, like these same ideas, if you are using the PEFA like under budget variance to look at budget outturn and all those things, these ideas are going to be the same thing that you have to pay attention to. Then finally, your conclusion. Keep your conclusion simple, straight to the point. Tell us about the overall economic performance of the entity or on the consolidated fund, whatever the heck it is that the examiner will throw at you. Then you make some recommendations. So probably tax revenues are reducing, then maybe government can widen the tax brackets, or government should prosecute, GRA should prosecute taxpayers who are not paying tax. Okay, start prosecuting people. And that may increase, or you suggest that government put in place policies to increase revenue. Now, the reason why I'm not saying government should put in place policies to increase revenue, when you say that, you've not said anything. Because some of you in your analysis that I mark during our class period, you always say that, oh, government should put in place measures to increase revenue. You've not said anything. What measures? Okay, widen the tax gap. You got it. Okay, prosecuting non-tax payment citizens. You got it. Okay. Locking up businesses or seizing licenses of businesses who are not paying taxes. You got it. So give us specific strategies and don't write code words. Code words. And like I said, don't say, oh, the government performance is better than last year. Government, please, that KG2 English, like you're professionals. So you got to stop writing that KG2 English. It's better than last year. What is that? And you use better than last year in the first paragraph, in the second paragraph, in the third paragraph, better than last year, better than last year. Me neighbor. So just like stay in your lane, but just make sure your analysis, it's just cute, like precise, not cute, precise, sorry, precise and direct to the point. And you should be good. You should be good under the ratios. Then finally, you come to the financial statement preparation. My plea to you is this, that let the final accounts preparation be the last question, all the things being equal for you to do. That is my recommendation. If you remember in class, we spent a lot of time on that guy because you need to do all the calculations. Revenue, I mean, there has to be breakdown, expenditures, breakdown. You read a footnote, you have to calculate. You have to calculate, especially those, the Mokola people punching things by heart and making unnecessary noise. So I will recommend that will be your last but one question. What does that mean? It means by then you have done the theories. By then you've done your ratios. Then you can go to the final account. However, if you read through something and you can't do it, don't sit down and be wasting time on it. Go to something else you can do. So maybe there is a theory question, 10 marks. It's about something you freaky don't even remember about it. Stop it. Don't start there, be thinking and be chewing your pen like this. Then you are looking in the sky. What are you looking in the sky for? Just stop it and go to something else you can do. Okay. So if there's something you cannot do, just drop it, go to something else. Make sure you answer questions, each question on a fresh page. And I think you should be good in that regard. Especially in your calculation, please take your time in your punching. Because some of you, you're going to screw up in the exam hall, not because you did not do the right thing, but because your calculator deceived you. And not because the calculator deceived you, because opre dodo. So you want to take your time in the exam hall in punching these figures up. Because if you miss one of them, a lot of things could be affected. So take your time when you're punching, calculating the ratios. Take your time when you're dealing with the final accounts as well, so that you get the right figures. Because in ratios like this, if your figure is wrong, your analysis is wrong. Forget about the English you wrote. It's wrong. So take your time in your punching and make sure you are using a reliable calculator. Like I say always, you format the calculator when you are starting. Then in the middle, as you are punching a lot of things, you format it again, making sure that you take your time on that. Then certainly, finally, get ready to stop work. You want to drop your pen, whatever the heck you are at, drop your pen and try to read over the English that you have written on the question 1A, the English you've written on procurement, try to read it. The analysis of financial statement, try to read it to make sure if that is what you are trying to say. Because sometimes they say the head is faster than the hand, because in your hand you are writing but then something else is processing in your head. So you have to be mindful of that. I know you're not going to do that, but it is my recommendation that get ready to stop work, you drop your pen and try to go over the things that you have understood, you have done, because that way you set yourself up to sort of confidently say, okay, at least what I've written, it sounds good in my ears, it's grammatically right, I got my spellings right, I got my figures right. So examiner, you do what you do, and by the grace of God, I should be able to pass the exams. So that is what I will say generally there. Read through the questions very well. Start with what you can do best first to let the examiner know you know, and then let the calculations be your last but one question. And once you do that, you should be in a better position to pass the examination in that case. So that's what you need to understand. And that's the last thing I will share my thoughts on with you in that case. Priscilla Yeboah said, strategy, I'm a little scared. What kind of strategy? Okay. I think I've answered a question on the strategy that you should use. Like I said, you answer the theories first. Don't be scared. It's exam. Haven't you written any exam before in your life? Some of you did MBA, MSc, MQC. You're even pursuing PhD. What is ICA? Right. Then NC that. So relax. Okay. If you're freaking out, just take a deep breath, grab some water, sip it. It should be okay. All right. It should be okay. So that's it about that. We wish you all the best, and we hope to see you at graduation. No, level 2 they won't do hoye. You in level 3. So that's it about that. Let's see. Stephanie said, thank you. Always a pleasure. Jacomani said, in fact, you are a coach. Okay, thank you. Thank you for the blessings. Yep, because I'm a blessing, I gotta bless you. Okay, so that's it. Take care of ourselves and wish you all the best. If there are any things before 9 a.m. tomorrow morning, holla or send me a message before 9 a.m. tomorrow morning, because after 9 a.m., I'm not on the planet. I'm in the moon. Okay, good night and get some rest, and I'll catch you some other time in May. Au revoir. Mesu akpeo. Now that you want me to start speaking away here. How can I speak away?